So today on Toni Talks, I'll be joined by attorney Sergey Garayants and CPA Gary McHenry. Today we'll be talking about what is self-employment tax and how to calculate it. So we'll talk about who pays the self-employment tax, what is the self-employment tax, so what's the calculation, and how to mitigate the tax effect. Well, today I wanted to talk about a hot button issue, self-employment tax. And what I want to do is I want to make sure folks have a very good understanding of, number one, what self-employment tax is. But first, before we get into what self-employment tax is and start, scaring the pants off you, let's talk about who has to pay self-employment tax. Who is subject to self-employment tax? Sergey?
Absolutely. Self-employment, it is a hot button issue, I must agree with my colleague here, because almost every single one of our clients is involved in some form of business enterprise, whether it's active business or not. It kind of depends, but generally, self-employment tax is a special type of tax that is paid or carried by sole proprietors. That's the individuals who do business in their own name and without having an incorporated entities. That also includes individuals with DBAs. That also can include your LLCs, both single-member LLCs and multi-member LLCs, if they are engaged in an active business. That also
and that's single-member and multi-member LLCs that have not made the election to be treated as an S or a C corporation.
Absolutely. So we're talking about a disregarded LLCs or a partnership. And another kind of a unique category that is subject to this type of taxes are dealers of certain commodities or trades, but in that regard, they're almost like sole proprietors as well. Mm-hmm. There are special rules, and S and C corporations are not subject to that tax, which we'll talk about in a moment.
Right. So just to touch on it real quick, because I know we're talking about self-employment tax today, but to touch on it real quick, the sole proprietorship, and I really like the fact that you brought up the DBAs, because we do have clients who do like to go out and get a DBA. That is not providing you with any asset protection.
Yeah, so what the DBA is, literally what it stands for, doing business as. And what it is, it's a special name that you either as an individual, principal doing business, or an entity, alternatively, can do business under. So most common reference to DBA is actually trade name. If you have a business, if you have a company that is registered under one name and you want either use an alternative names for marketing, promotion tools, and other purposes, you can also acquire and apply for a DBA, which stands for doing business as, which gets linked either to you as a person doing business or to your company. But it is not, even though in many cases they are filed with the Secretary of State office, it is not an incorporated entity such as partnership, LLC, limited liability company, or a corporation. So please don't get the two confused, because DBAs do not provide asset protection.
Right.
It's just a trade name.
Right. I want to keep the conversation going, but I thought that was a very important point that we kind of stop and say, okay, you can do a DBA with a sole proprietorship.
Absolutely.
And they take on different names. Like you said, you can register a trade name. Yep. You can, some states, counties call it a fictitious firm name. Yep. Whatever the case is, it's not an LLC. But you can have an LLC that is single member disregarded, and that's going to be subject to self-employment tax if the activity of that LLC is actually active and not passive. So earned income, right? So we're talking about, reporting on the Schedule C. So if you have an LLC where you are selling widgets out of, those widgets or the sales proceeds of those widgets are going to be reported on your Schedule C. Yeah. And then on your Schedule C, the net income is going to be subject to self-employment tax, versus if you were an investor in, say, rental real estate, that's different form, that's Schedule E, that's passive, not subject to self-employment tax, or you're trading as an investor, once again, and we talked about that in an earlier Toni Talks, investor versus trader. You might want to check that out. If you're an investor in the stock market, not on Schedule C, you're on Schedule D. That's capital gains, whether it be short or long term. That's going to be capital gains over there, not subject to the self-employment tax. It's all portfolio income, passive income.
The most general category, just to kind of make it easier for folks out there in the video land, is that if your business involved in a sale of goods or sale of services, chances will be significantly high, almost 100%, that you may be subject to self-employment tax unless you do that activity in a special type of entity, such as a corporation, SRC corporation, that are not subject to that tax. So sale of goods or services, that's your kind of primary point, and if you are involved in that area, you're almost undoubtedly will be subject to that tax requirement.
Let's hop into, and Gary, I wanted you to weigh in on this if you can. Let's talk about what self-employment tax is. This is the scary part, folks, but don't worry, because we're going to get into how to, Gary warned me against using the word avoid because IRS doesn't like it. So we're going to get into how to mitigate self-employment tax after that. So don't get too worked up, but let's get into it. What is self-employment tax? How's it calculated?
Well, self-employment tax is the equivalent of your W-2 tax for Social Security and Medicare. So as a self-employed person earning that type of income, either as a sole proprietor or as an independent contractor, you have this income to report on your business entity, and it is subject to that income. But in this situation, since you are both the employee and the employer, your Medicare tax and your Social Security tax has to be doubled from the 7.65% to 15.3% because you are responsible.
In addition to your ordinary income, yes?
That is correct. Yes, you will. This is a tax that is added after your ordinary income tax has already been calculated. So typical add-on tax, which we hate and want to do away with, but they do need these taxes in their coffers. So they have added this tax to those of us that would earn self-employment income so that we are funding Social Security and Medicare both as an employee and employer. So as reporting that on your return, you would get down to the net income from that activity, and that net income would flow to a Form SE, and that is the form which will calculate your liability at the 15.3%. And I think it's of 92.35% of the net income from that self-employment, so that then you report that calculated tax to the ultimate tax calculation on your 1040. So that is what self-employment tax is, Social Security and Medicare being provided to the government by the self-employed sole proprietor independent contractor.
And then also we have your additional Medicare.
Yes, they have added an additional Medicare tax at 0.9%. Which is on income, I think, over $250,000, so that gets funded along with your tax return as an additional tax that's just calculated as part of your tax return.
But then we also have a phase out.
We do. That can phase out with the Social Security tax. It phases out, I think, in 19 at 132.9, and for 2020 it is 137.4 or 137.7.
Close enough.
Close enough. I know I'm in the ballpark. I don't memorize these things anymore, folks. There's too little up here.
Oh no, it is exactly 137.7.
Is it really?
Yes.
Okay, well then we are close. So that's good. So we do have the phase out on the Medicare side, and the self-employed would also meet that phase out, just like a W-2 person would.
Right. So we're talking about some significant increases in tax if you have considerable income, because we are talking about your ordinary income tax rate, which can go up to, how much is it now?
37%.
37%. And then you're going to be looking at an additional 15.3% on the net income from self-employment tax. We do have phase outs like Gary talked about as relates to the Social Security and then 132.9. But this can be quite punitive, if you will, to employ yourself. Because you don't have that employer-employee relationship, and the employer picking up half the tab. You are the employer, so you have to pick up both sides of the tab. You're a horrible date to yourself.
And that's an important point, because you do get half of the SE tax as a deduction, as an adjustment to income.
As an adjustment, yes.
Right, but not a direct expense lowering the net income of the business. So,
right.
It is an adjusted gross income adjustment, but it isn't deducted against your business income.
Right.
So
very good point. So now that we've kind of gone over who is subject to the self-employment tax and then what the self-employment tax is, it really boils down to the 15.3%. I mean, that should be your takeaway. It's 15.3% in addition to your ordinary income tax rates. How can we mitigate self-employment tax? Well, there's, I would say, 3 different types of entities that come to mind instantly. But where I'm going with that is take it off of your personal tax return entirely. I like to take, if the activity is any kind of material participation activity with the exception of rental real estate, I want to take that off of your personal tax return and put that in a vehicle that gives us and yourself more control over how much, if any, we want reported on our personal tax return. 2 examples that come to mind for me is a corporation and a limited partnership. The corporation can be taxed as a C or S, and I think I'm going to turn to Sergey to get into a little bit more of that. But the limited partnership, you have 2 parties in a limited partnership. You've got a general partner.
Correct.
And you've got a limited partner. The general partner is the partner that is, well, I should probably turn to Sergey for that one as well. You know what, Sergey, take it over.
Well, so as Toni pointed out, there's a few entities that actually can save you in this situation and can help you with your tax planning, and as one of our partners like to put, with a tax appetite. What we're talking about, limited partnerships and 2 types of corporations, meaning that a corporation with a tax election as an S corporation and a corporation with a traditional tax election of a C corporation. A little bit about limited partnership. First and foremost, limited partnership is a unique legal entity. It's different than a general partnership, so don't confuse the 2. The unique feature of a limited partnership is that A, in almost every single state, it must be registered with the state Secretary of State office, while general partnership can be created by contract in some cases. And in limited partnership, you always have 2 types of participants. You have a general partner who is generally responsible for business management and administration and will carry certain liability with it. Legal liability we're talking about. And then on the other side, you have a legal partner who in many cases act as an investor, providing capital. Yes, a limited partner, providing a capital and do not participate in active business management. Well, first takeaway in that equation is that limited partners are not subject to self-employment taxes. Whether it's a person or an entity as a limited partner, they are expressly excluded from that category. So limited partnership is one.
And you want to be careful with that, with the limited partnerships, because
Absolutely.
Limited partners are treated as passive in nature.
Yep.
A limited partner cannot actively participate or materially participate in the business. That's up to the general partner, and the general partner remains wholly liable for the activities of the limited partnership. And that's that limited liability that you're getting as being a limited partner is what's protecting you, but
Absolutely.
also making you passive. So the moment you start actively participating in that business, you're acting as a general partner, and you are putting your limited liability protection at risk.
Yeah, so the test is not how you filed and formed that entity per the partnership agreement or the operating agreement if you use an LLC structure as a partnership, but its actual conduct here is determinative. So if you entered a business arrangement as a limited partner, and then at some point throughout the process you start getting actively involved in business management and operations, that conduct will effectively can invalidate your limited status, converting you into a general partner. And only because you filed the paperwork with the Secretary of State or incorporated entity a certain way, it's not the sole determinative factors. Your conduct is another important factor here, and you need to make sure that you stick to your limited role in limited capacity, and that is stay away from business operations. It's not your sort of area to get involved with if you are a limited partner.
So let's take a step back a little bit and make sure everybody understands why we're really harping on you as the limited partner. Yeah. So we're not going to recommend that an individual act as the general partner, because if an individual were to act as a general partner, well, we're just putting you right back in the situation where you're going to be subject to self-employment tax. What we recommend is that you have a C corporation act as the general partner, and a C corporation is not subject to self-employment tax. So we have our C corporation in as the general partner, and then you as the limited partner, and the income flowing to you as a limited partner will not be subject to self-employment tax. And so the allocation there is going to depend on the discussion you have with one of these guys as to how much of an ownership percentage do I want my corporation to have as a general partner? Usually minority, I think you mentioned that. And then,
depending on the activity, but yeah, in many cases we keep it at under 20%.
But we can have that as a lower percent. Sometimes we even go as low as 1%, and then we're going to have us as a limited partner. I've not lost any control over making sure I split the income the way that I want to. How? With a guaranteed payment. Okay, so whether I did 1% to the general partner who's a corporation or 20% to the general partner who's a corporation, if that allocation, that 20% allocation, doesn't equal, let's just say, the $5,000 guaranteed payment that we have, agreement we have in place, well then, in order to make the general partner whole, I have to, the business rather, the partnership has to make them whole by covering the difference of that. So if the allocation of income was $3,000 based on their ownership, the corporation's ownership percentage, you've got to pay another $2,000 up to the corporation, and that's income splitting. So we have the means to kind of split that income off and do tax planning to work with how much we want to have land on our personal tax return and what kind of deduction we can create by using the guaranteed payment. But let's talk a little bit about
more simplified options.
Are they simplified?
Well, there is actually even a simpler option. So limited partnership is definitely a great tool, open up a lot of possibilities, but another couple of a little bit more sort of a straightforward arrangements that I want to touch on is your ordinary corporations. Ordinary meaning traditional corporations, tax as an S or C, or it alternatively could be a limited liability company so long as it carries that S or C federal tax election status. Because as I said, if you remember a moment ago, we mentioned that usually businesses and companies or individuals that are involved in the sale of goods or sale of services will almost undoubtedly will be subject to self-employment taxes unless they use a proper type of entity. So depending on what you do, you can form a corporation. And again, it could be either a C corporation or an S corporation. There's a couple of differences between the two, but you can conduct business as in the name of your corporation, so long as it's the proper type of setup and certain types of tax filing forms involved. You will also be exempt from self-employment taxes in certain situations. If you're involved through a C corporation, usually as a shareholder, you could be entitled to dividends, but you will be also eligible to earn a W-2 salary, regular income. Some of the expenses that has to do with paying that salary can be actually a deduction for a corporation. Things like employment tax credits, additional perk of why you wanted to earn a salary as opposed to claim it all through Schedule C of your personal income tax. And with an S corporation, you actually have an obligation to pay yourself a reasonable salary, which at that point treat it as a W-2 wage as well, and not a income from a business.
So the takeaway that I want you guys to get from this video today as it relates to self-employment tax is the C or S corporation distinction is that in the C corporation, you are going to be taxed at a flat 21% today.
For now.
Correct.
However, in the C corporation, you can take funds out of the C corporation deductible as reimbursements. We have the 280A meeting room expense, where you rent your home to the corporation up to 14 times a year. The medical reimbursement plan. We have things of that nature where you can take the money out. And then you can also take the money out, to Sergey's point, of the corporation as a salary, but you're not required to.
Yeah.
In an S corporation, in contrast, you are required to take a salary. However, keeping in mind, back to my original point, when it comes to self-employment tax, I want to pull the activity off of the personal tax return, so I retain control over how much is going to be allocated onto my personal tax return. And the S corporation is going to help you do that, because although you are required to pay yourself a salary from the S corporation, keep in mind that is related to the distribution that you take out of the S corporation, right? So if you're going to take a distribution out of the S corporation, the distribution is not taxable as long as it's not in excess of your basis. You're just paying the tax on the flow through of the income. That's an important point we didn't mention. S corporations are flow through entities, so you're going to pay the tax on the flow through allocation of your shareholder interest on the personal tax return. You can then take that money out as a distribution. Now, when it flows through, you're only paying your ordinary income tax rates. You're not paying self-employment tax. IRS is very well aware of that, which is why they require you to pay yourself a reasonable salary. Now, you're going to look at the market rates for that and what's the fair market value of the services that you're rendering or providing to the S corporation. But rule of thumb, you just don't really want to take more out of the S corporation as a non-dividend distribution than you're taking as a salary. Just try to keep that balance. Because what happens if I if IRS comes in and determines that I took too much out as a distribution and I didn't take it as a reasonable salary?
Yeah, if you take too much distribution and exceed your basis, you've created a taxable event there. So it becomes compensation to you, gets added to your tax return. And so right away you've added tax to your tax return.
Right.
So these great points that they're making here are great tax planning tools, because to give you an example of that, if you have a Schedule C in your tax return, one, more subject to audit than the S Corp would be. So you've opened yourself up there for review.
And sole proprietors here are notoriously kind of suffering from that rule. That's why another reason we don't suggest to do business as a sole proprietor at a very minimum.
So, and if you take $100,000 there of income from that business, you move it to an S Corp, maybe a reasonable salary there now is $40,000. So then maybe you could make a contribution to a retirement plan. So now instead of having paid tax on that contribution, you've deferred it till later. So now you've really lowered your tax effect, gotten rid of SE tax, lowered your ordinary tax, and put some away for the future. So a lot of tax planning tools here.
Absolutely. And these guys, if I let them, would go on for hours. Gary done started deferring income, which is fantastic. And we want you guys to benefit from that. So give us a call, get a consult scheduled to one of these guys or both of them. And I hope you enjoyed our content for today and having a little chat with us. Have a good one.